Joining us here at Post 9 is Apollo Global Management Chief Economist Torsten Slok and Edward Jones Senior Investment Strategist Mona Mahajan. Good morning to both of you. Torsten, I'll be watching the 2024 median dots on rates next week. What are you going to be focused on in the Fed meeting?
Well, going into this meeting, what's really interesting is that they have put so much focus on being data dependent. And their own data is pointing towards all kinds of directions. If you look at the Atlanta Fed, GDP now estimate says that GDP in this quarter will be 4.9. The New York Fed says it will be 2.25. And the St. Louis Fed that we're actually already in a recession in Q3. So going into this meeting, we're certainly watching, of course, what they've been saying.
Who's got the best record there?
Well, some of them don't have a long track record, and the New York Fed actually took a break and then started publishing again. But the bottom line to your question is, watching the dots is very, very critical. But the data is indeed slowing down, as the textbook would have predicted. We've seen employment growth slow down. We've seen capex spending slow down. A number of labor market indicators have slowed. We've seen a number of job openings come down, the work week come down, the quits rate come down. So a number of things are moving in the direction that they want, but we are just not quite there yet, and that's why the bottom line to your question is they will probably signal that we are almost getting there, but we are not quite at the final destination yet.
Is that a risk to equity investors, Mona, into next week, that they'll signal hawkishness still, that there's work to be done?
Yeah, look, I think the Fed will be reluctant to declare mission accomplished, but I think the markets have started to embrace this position that perhaps we're on this pace for an extended pause. The September pause was kind of baked in the cake, but we're starting to see even November, which had been closer to 50-50. Market expectations have come down for any sort of rate hike in November and beyond. And in fact, markets are pricing in a pause until mid-June of 2024, where they see the first rate cut. So we think this is a more credible scenario, higher for longer, until we do see, especially that core inflation number, continue to cool and moderate towards a 2% figure. To Torsten's point, we're starting to see early leading indicators of job softening, labor market softening, not only in the openings and quits, but also we're starting to see a consumer that may be slowing down as well. We know that they've worked off a lot of their excess savings. We're also seeing interest rates remain elevated. And of course, we're ending this summer travel season with financial conditions, bank lending standards remaining pretty elevated here. So it'll be interesting to see. Markets are expecting a slowdown in the economy, not recessionary, but a below trend for Q4 and Q1. We think that is reasonable, probably not going into any deeper, prolonged recessionary environment. But then we can reemerge in 2024 with a Fed that might be on pause, thinking about rate cuts, inflation that might be moderating, and maybe growth and earnings that could be rebounding. So not a bad environment as we look further out into next year.
We do have this new auto strike, and it's targeted, and we don't know how long it's going to last. But the Fed has to be watching it. Certainly the impact on inflation and supply chain, the longer it lasts. Do you expect an economic impact?
So if it's short-lived, then it's probably going to be, of course, quite mild. And I completely agree. They're probably watching it very carefully. But if it is going to be more longer-lasting, it could certainly have a number of ripple effects across the supply chain, across the broader economy, and a number of different dimensions. So for now, it looks like we don't quite know how to quantify this effect, but it is probably something exactly as you're saying that they're going to be watching very carefully.
What about the student loan impact? Also, some estimates all over the map as far as whether that is what really starts to dent consumer spending.
Yeah, absolutely, because half of everyone who has a student loan is going to resume paying, and it will be on average about $140 in increased payments. So the conclusion is, combining that with what Mona was saying, we are seeing Essex savings running down. We're also seeing delinquency rates going up on credit cards and auto loans. We're also seeing default rates going up. So the broad picture really here is that interest rates are biting harder and harder on consumers. They're biting harder and harder on corporates. And that's what the textbook would have predicted. That's what the Fed would like to see. We're just not quite there yet. But they are certainly seeing exactly what they had planned for since they began hiking rates in March of last year.